Hello and welcome to Closed-End Fund Mastery. Today's video is going to be part one of a two-part video. Today we're going to do something a little different than what you're probably used to see me doing in my videos. Today I made a couple additions to the DivX high yield portfolio, which is the results you're looking at right now. And I thought it would be interesting to go over the process from alert to research to execution involved in making the addition to the DivX high yield portfolio, as well as include a tip that's going to automatically make you a better investor. And then in the next video, part two, we'll be setting up our purchase in the DivX system, and I'll be walking you through all the settings that I'll be using for our latest addition to the high yield DivX portfolio. For those of you currently not familiar with Closed-End Fund Mastery, Closed-End Fund Mastery currently ranks and scores 326 of the highest yielding closed-end funds. Soon I'll be releasing CEF Mastery, which is currently free to Mastery subscribers while it's in its development stage. Release date to be determined. And I also just recently released a BDC Business Development Scorecard, which is free to everyone that signs up to my free weekly newsletter. Simply go to my product page and enter your email address at the top and click subscribe. The link is in the description below. Now on with the video. For many years I always considered myself a fundamental investor. My routine would consist of entering a series of criteria into a stock screener, check out the price to earnings ratio, and if it wasn't too expensive, then check the financials, and if it looked good, I would put in a buy, only in many cases just to have the share price drop. And because you're a long-term investor, you would think to yourself, oh well, no big deal, it'll bounce back. But depending on the size of the drop, you knew in your heart that really sucked. Now I no longer look for investments to buy into. I wait for those investments to come to me. Just over 4 years ago, I ventured into options trading, which is where the bulk of my personal returns actually comes from. But getting into options, I was forced to learn technical analysis. And here we are 4 years later, and I still consider myself an advanced beginner. Anyway, since I started trading options, my routine changed from looking for stocks to invest in to managing watch lists and setting price targets and drawing lines and trends, but mostly price targets. And by doing so, I just patiently wait for price action to bring investments to me. As you can see over here, I have my watch list for regular options, but I also have other watch lists as well. Most of these are outdated, but the ones that I concern myself with the most are BDCs, CEFs, ETFs, and my regular options. Today, November 4th, 2024, I got an alert that one of the funds I set a price target on had been triggered. DMP, triggered at a price of $9.10. Knowing that this is a closed-end fund, I immediately go to my closed-end fund watch list and I pull up a chart for the fund DMP. Now the trigger I had set is already gone because it has been triggered. Now here's where the tip comes in that's going to automatically make you a better investor. If we go back to my watch list, you can see that the price of DMP was triggered at $9.10. Go back to the chart, you see the horizontal line that's following the mouse? It bounced right off of that price target of $9.10. Now that price target would have been set weeks or months ago. So how did I know that eventually the fund would reach a price level of $9.10? And the truth is I didn't know. So how was I able to make such a well-educated guess that DMP would hit a price target of $9.10 in the future? If you follow this white horizontal line, see it going up and down as I move the mouse. If you follow the white horizontal line, you can see it hits touch points right here, right here, here, back here. This is what's called a line of support. If the price target continued to fall through that line of support, this line would then become resistance for the fund on the way back up. Or it could bounce, as you can see right here where the wick expanded and the fund wound up closing the day out at $9.18, which is 8 cents higher than the price target I set. So there's your pro tip to make you a better investor. Look for lines of support. If your investment drops below that line of support after you made your purchase, it won't be pleasant, but it won't be nearly as unpleasant than had you made your purchase up here. Okay, so now we got the alert. Did we make a buy? Before I answer that, I want to make just 2 quick points. First being, you do not have to have a fancy setup like I do here with Think or Swim by Charles Schwab. Any broker will allow you to set alerts. And secondly, if this chart looks a bit intimidating to you, you don't have to use a candle chart. You can use a simple line chart. Here's a chart on Seeking Alpha for DMP, 1-year time frame. And you can see where the horizontal line has several touch points going back. However, the bulk of these touch points using the line chart would not have triggered an alert at $9.10, so you would have missed it. However, just because DMP bounced off that line of support doesn't mean that it's finished falling. As a matter of fact, with the election being held tomorrow, all kinds of crazy things can happen. We'll just have to wait and see. Well, before we commit, let's take a closer look at what we have here. Looking at the chart for DMP, we can easily see that as of their last reporting period, they were able to easily cover the distributions of $142 million with the combination of income sources from net investment income, realized gains, and unrealized gains. For the 3-year and the 5-year NAV return with distributions reinvestment, they're both in the positive. The long-term NAV price change is negative 1.43%. That's insignificant. As of the end of April 24th, their last reporting period, they had a score of 22. Which isn't a qualifying score, but it's not a bad score. A huge turnoff for me is the rather large debt to equity ratio of 40%. Here we can see with the combination of all income sources that the distribution of $142 million was covered by 183%, which is apparent when you can see how much higher the unrealized gains surpasses the distribution line. The distribution yield to reported NAV was 10%. The income from all income sources equated to 18.4%, giving DNP an 8.3% surplus in excess of distribution, and ended the period with a surplus of 14%, equating to the equivalent of 14 monthly distributions remaining. Since it last reported, despite the recent pullback, it is still up 15.4%. The discount has increased by 5.7% since it last reported. Has a nice yield, 8.4%. The debt to equity has dropped about 6 percentage points, which is good, but it's still unpleasant to me. And the reason it's unpleasant to me is because I use leverage in my investments. So to add leverage on top of leverage is pretty risky. Also, I personally feel I don't need to take a chance on funds with high leverage ratios because there are likely funds out there that meet my criteria that do not require as much leverage. And lastly, the increase of 15.4% in the NAV, the net asset value since it last reported, brings the estimated monthly distributions remaining for DMP up to 33, and it also has a final score of 43. This fund looks very good, but it's not for me because, as I mentioned, the high debt to equity ratio is just not to my taste. So the answer to the question, did we make a buy, is a no. However, we're not done yet. Since I went through the trouble of traveling all the way over to
my closed-end fund watch list. I want to see if there's any other funds that have had a pullback. And since I always go for the big yields, I'm going to sort my watch list by yield. And all I'm doing is looking for a similar type pullback. As we can see right here for the fund AOD, you can see the level of support right here. It was resistance back here, but it's support right here. And it's sitting at support. So that looks like a good fund. And it has a yield of almost 14%. So we'll add this to the 5v5 chart. First glance, I already like what I see. Reported score of 32. All reported income to distribution of 337%. Reported income in excess of distribution 17.5%. Did have slightly negative accumulated earnings equating to a -1 monthly distribution in the whole. It's up slightly since it last reported by 3.1%. The debt to equity ratio is well within my range, 9.5%. And the 3.1% increase in the net asset value percentage change is estimated to bring the estimated monthly distributions remaining up to 4, and it has a final score of 38. With a current yield of 13.8%, this fund looks really good to me. But I'm going to keep looking just a little while longer. NMAI. That's quite a pullback right here. It's found support currently on the 200-day moving average. And if you look at the horizontal line to the left, look at all the touch points that it's resting on for support. So this is definitely a contender to consider. We'll go ahead and add that to the 5v5 chart. Right off the bat, I see quite a few things I'm not crazy about. For example, the fund has a reporting history of less than 5 years, and it's already got a long-term price depreciation of nearly 31%. It has a score of 15, which is not nearly as attractive as AOD's 32. Failed to cover its distributions. You can also see that indicated in the chart down here. It's got a lot of red. You can see that its income failed to meet its distribution by 3.2%. A greater number of negative monthly distributions remaining. NAV percentage change hasn't improved that much, but anything's better than nothing. Currently sits at 0 estimated monthly distributions remaining. Has a higher debt to equity ratio than DNP. So I'm definitely not digging this one right now. So of our 3 contenders right now, it looks like AOD is the most attractive. Now believe it or not, all the hard work has already been done. I found a fund that has pulled back to a support level. The fund has really good scores. Has reported income well in excess of the distribution amount they paid out. Currently has a positive performance, and that is after all distributions have been paid or declared to date. Their debt level's well within my range. The only thing lacking is the number of monthly distributions remaining. Normally you would like to see at least 6, which would also be represented by a green filled cell. But for a fund currently paying 13.8% and everything else so far looking so good, I'm ready to make a buy. However, in the interest of being thorough, I want to check out a couple things that might dissuade me from making an investment in AOD. What you are currently looking at is the fund stats page for the fund AOD. On the fund stats page, it provides lots of historical and performance data on any particular fund. And some of the ways we get to look at these funds is unique only to closed-end fund mastery. For example, if we go to the owner's equity chart, this chart presents 2 balance sheet items, paid-in capital and undistributed earnings. But unique to closed-end fund mastery, we overlay it with a cash flow item, shareholder distribution. In doing so, it allows us to see if the current shareholder distribution can be managed with the use of paid-in capital and undistributed earnings, which are the end results of all transactions into and out of closed-end funds. Now, the 2 main things I'm concerned with on this chart is whether the undistributed earnings maintains a positive balance, which it currently does not. But going back through the history of the fund, we can see that this is not unique to the fund. So this isn't a major red flag. One major red flag would be in the absence of a positive undistributed earnings, would there be a significant decline in the paid-in capital? Or put another way, is there an excessive amount of return of capital? And as we can see here, over the last 6 years, since April 2019, there has been a modest decline, which is perfectly acceptable, especially for a fund that's paying 13.5% in yield. As a matter of fact, since we're here, check this out. This small decline of capital over the last 6 years only represents an annual average return of capital of around 4%. So on a fund that's paying 13.8% in yield, you subtract the annual return of capital average of 4.16%, you still have a nice yield of around 9.7%, which is still higher than the 8.5% being offered by DNP. Plus, you get the little added benefit of tax-deferred income from the 4% annual ROC. Pretty cool, right? Now, getting back to our owner's equity chart, we're almost done. What we want to see going forward is pretty much the same thing. Up and down fluctuations, obviously more up than down fluctuations in the undistributed earnings. The continued modest decline of returning capital is okay. Eventually it's going to have to be addressed, but it's not an immediate issue. Market price action is going to play a role in how I manage this fund in the future. We'll go over that in a little while. But what we don't want to see is a disruption in the norm. For example, an extreme spike in paid-in capital would mean a lot more shares that need to get their 13.8% dividend. That could be a cause for concern. Or we don't want to see a sharp decline outside of the range of what we already see in the undistributed earnings. So that's what we're looking for going forward. Now onto the balance sheet. Over the last 5 years, the fund's debt to equity ratio has been trending upward. Here you have a low, a high, a higher low, higher high, higher low, higher high, higher low, higher high. But it's still only a mere 9.8%, which is well within my preferred debt to equity level range. I might be willing to go as high as even 20%. Now, unlike in the last video on the realty sector where I showed you that a rising debt to equity ratio could be a sign of trouble if it's increasing as a result of a decline in asset value. That's not so much the case as it is here, where you can see just recently they actually increased their leverage amount by taking on more liability. And hopefully the additional funds received were used to acquire more investments, which is going to help boost the undistributed earnings portion of their balance sheet. Next, we're going to look at the income chart. Again, if you remember from the last video on realty sectors, I'll show you how to smooth out unusually high and low activity of a fund's unrealized portion of its portfolio by removing them from the chart to give you an idea of normal activity. As a matter of fact, let's add these last two back in. There we go. And you can see all in all that in the absence of unrealized gains, the fund is pretty much able to manage the current distribution level with net investment income and realized gains. And notice, and I see this a lot, when the fund actually has positive net unrealized gains, they usually take that opportunity to unload some losers in their portfolio by taking realized losses. But all in all, this looks healthy to me. And lastly, I'm going to look at the
score history chart. The scores have been trending up since the end of the bear market in 22. But what I want to really take a look at is the number of distributions remaining. And you can see that at the end of the bear in 2022, it reached a low of -23. So we could possibly use this as a reference point of how low the fund can go and still manage to maintain its distribution without taking a significant hit to paid-in capital. And we can also see that despite paying a relatively large yield, the trend of distributions remaining has been going up ever since. Okay, so now I'm done. I have seen nothing that would dissuade me from wanting to make a purchase in this fund. Okay, here we have the daily account activity in my brokerage account for November 4th. I'm not going to make this a habit because generally I'm a very private person, but I think this screenshot encapsulates a lot on how I approach my investment activity. So real quickly to begin, you can right away see my 200 share purchase at 8.7085 a share. I also added to the FDUS Fidus Investment Corp position for the DivvyX high yield portfolio. I had a small swing trade position in General Mills that was just hovering around the 200-day moving average, and because I usually maintain a margin balance on my account, I generally don't like to see investments just sitting there doing anything. So when the alert came for DNP and I found AOD, I thought the investment money would be better suited there because the long-term reward potential for AOD, as I'll show you in the next video, when I set up AOD in the DivvyX system, far outweighs any potential short-term swing gain I would have got from General Mills. And I also used some of the proceeds from General Mills to increase my position size in FDUS because Fidus just reported a decent quarter. They raised their dividend and it pulled back to my cost basis. So that seemed like a no-brainer to me. And I mentioned earlier in my video that I also trade options, which is where I get a large portion of my investment income from. On the same day, I was also able to get some really decent premium for a $38 stock that was $12 out of the money with AAP, Advanced Auto Parts. Here we are at the close of the next trading session, and as you can see, the fund AOD did currently bounce off of that level of support. You can see my buy order for 200 shares at $8.71 over here. However, this isn't a done deal yet. This thing still could go down. Tomorrow is an election. It could wreak havoc on the market, so you have to be prepared for anything. But regardless of what happens tomorrow, this is where my mindset is. If, at this point, the fund continues to increase in value, I'm happy. If this level of support does not hold, I will likely accumulate more shares at the next level of support, $8.45, if that level of support holds, or even if the fund finds support at the 200-day moving average. If there's a modest dip below this support level, say to maybe 831, I will still consider the support level held. And then you can see we have another support level around 812. But of course, the ultimate factor on whether I decide to hold or even add more to the position will likely be based on the feedback that I receive from the information contained in the current performance portion of the super screener. If the fund hasn't reported yet, and if the fund did report, it'll be based on all the information contained in the super screener. Okay, that's the conclusion of this video. Again, the speed of this transaction from alert to research to buy happened so quickly. I thought that showing a real-time process about how I go about making a trade would prove useful. Again, a lot of the information provided in this video was based on my personal strategy, my own opinion. You could possibly incorporate some of this into your own strategy, but just know that it is purely opinion and does not guarantee future results. Again, if you haven't already, hit the like button, subscribe if you haven't already, and look in the link below for information on how to subscribe to Closed-End Fund Mastery. Take advantage of ETF Mastery while it's currently free. and subscribe to my weekly newsletter, where you'll also be able to receive my weekly BDC Scorecard. All the best. Take care. Thank you.